prospects, challenges and road ahead. That was the big theme at the CII 7th Banking Colloquium held in Kolkata in September this year. Event brought together some of the best minds in the banking industry. It also saw the release of the CII Deloitte report on the role of banks in a new phase of growth. The report release was followed by a panel discussion which included the heads of banks and other financial institutions.
The market's very gung-ho about green shoots in economic recovery. But looking at the bank credit growth number that we saw for the fortnight ending September 5th, which has fallen to the lowest in the last 5 years, the question is whether this kind of growth, the credit growth, will be able to sustain 5.7% or say 5 to 5.8% GDP growth that we are talking about. So is that going to be sustainable? Let's ask the bankers and also ask them what kind of role that bankers can play in not just reviving growth, but sustaining the current level of growth. Well, Mr. Kaul, if I can begin with you. Bankers are hoping for a 14-15% growth, credit growth for this year. But looking at the numbers that we saw last week, are you optimistic that bankers will be able to achieve a credit growth target of 13-14%?
You see, yes, I agree. If you look at the growth, recent figures have come out, it's below 10%. It's probably the lowest we've seen in many quarters in the last many years. But let's not forget two things. One, this is a slack season for credit demand. Normally, credit growth starts in the second half of the year. Since we still are very large agro-based industries, they start accumulating the raw material in the second half. However, we do notice not many new projects coming up, not much investments taking place. The growth in the credit we see the banking industry is primarily coming either from the push the banks are giving on the retail side, retail, SME, agriculture, or the demand comes from the corporate sector because of enlarged working capital requirements. Now, since the second half growth is normally there, the busy season, we do expect that banks will come to RBI expectation of 13-14% growth by the end of the year. If you look the past many years, the major growth in credit comes the fourth quarter. So I hope this year also the same trend would continue. Although the first two quarters, or till now, growth is lower compared to the previous years. But I hope the second half of the year will see a good growth. And probably we can reach 13-14% growth as projected by RBI.
So therefore, you are saying that GDP growth of 5.8% is certainly possible for this year?
Should be possible. That is what the RBI projections are. If we're able to get 13-14% growth of credit, we should be able to get a GDP growth of 5.5 to 6%.
Mr. Dubey, the other banker that I can go across to, are you also sanguine about a credit growth, achieving your credit growth targets for this year?
Yes, we are already on way to achieve. We will surely achieve. We had been very aggressive on priority sector, MSME and retail portfolio, where the growth had been priority sector about 30% plus, retail around 40%, MSME around 30%. Corporate credit growth, the wholesale business, is around 10 to 12%. It is lesser, much lesser. But we found some pickup in some sectors where our existing clients had been coming. Projects which were stuck up are coming on way. So I hope even if 12-13% corporate growth is there, we could definitely achieve our credit growth in Canara Bank.
We've seen a spate of measures taken by the RBI. Now, in order to stimulate growth, clearly we need to step up funding for infrastructure. Do you think regulations or measures like a 525 rule which RBI has come out with to help infrastructure financing can really solve this problem at this point in time?
I really don't think it can solve this problem in a very short period. You see, the 5x25 scheme itself, which took us 2 years to convince RBI now to get it on board, basically it was to reduce the fear of lending to large projects and infrastructure because the risk of NPA goes down, the risk of recession goes down. But that will take some time. I think the banks have to put through a credit policy and that has to be approved by the board. It will take some time to take off. But the given scenario now, there are hardly any, like Mr. Dubey said, there are not many new projects coming up. If at all any credit growth will take place, it must be through cost overrun funding, which I think almost every single project is coming up with a cost overrun. Not entirely due to be blamed to the project promoters or the projects. It is due to factors outside their control. But other than that, I think we'll have to wait for some more time. In fact, we have been holding these investor relations meetings I just come back from some meetings in London and Germany. They are all saying that we would like to invest in India, we are watching India keenly, but then there is still a lot more things you need to do. In addition to improving the segment, they say that you also need to make it a much easier place to do business with. Look, the investors are basically they are comparing to other countries. They say India is still a very difficult place to deal with. So this needs to change also. Additionally, I think even if the investment climate improves for large projects and infrastructure, I don't know what will be the capability of the banks to lend further. Because we are all aware of Basel III coming in. We are all aware of the capital requirements. We are all aware of the constraints in capital funding. So, and also the sector's caps. And these last 2 years have also been a bitter lesson for the banks. I think they will approach these projects a bit more cautiously. So therefore, we also need to look at means outside the bank to fund these projects.
Which then goes across to Mr. Srinivasan, outside sources of funding. How are you looking at the current scenario? How are you as an NBFC player looking to complement the banking sector and improving growth?
I completely agree that the revival in the large projects or the large corporate demand for credit will take some time. But I think one very nice catalyst that we still have as an opportunity in front of us is the smaller businesses, which is basically the SME and the MSME variety of customers. Now, there, the risks even today are actually speaking much lower. The level of leverage is much lower than what you would actually imagine. So there is a lot of opportunity for us to increase the funding on that side. Traditionally, what we have found is that although the SMEs occupy a very significant place in our GDP and employment growth and so on and so forth, and employment growth is one of the key factors that will lead to the revival. So if we really need to give a boost to employment growth, I think it is necessary for the banking system as well as players like us, the NBFCs, to give boost to the SME sector. Now, the SME sector traditionally, in spite of the focus that is really very much high on the regulators as well as the bankers' minds, has lagged in terms of its credit growth. Now, credit growth rate in the MSME sector is just about 50% of what it is for the corporate sector. So there is a lot of opportunity for the bankers as well as the NBFCs to come across and fill that gap and thereby give a boost to the employment, and therefore the economic cycle will start turning faster. One of the key factors or one of the key constraints in funding SMEs that bankers traditionally face is the fact that the very reliable financials and those kind of things are not available. So therefore there is a place where the NBFCs are actually occupied, because they go beyond the financial statements, and there is a fair amount of personal discussion based or reality check based or cash flow based lending that the NBFCs have mastered in. So this can actually be a very good way of diverting or moving credit to the right sectors in the MSME space. And we have been traditionally doing this for almost 7 years now, and over the period, I think we would have probably disbursed about more than 40,000 crores to the SME sector, and with very good results. Our NPA levels are very much better than the overall system put together. So the experience has been good. So there is a need for us to push this along considerably. Second factor is that India being a more service-oriented economy, it's very easy to actually lend to a manufacturing sector because you have some real assets and the factories and machinery and so on. But how do you lend to the services sector, which is typically asset thin? Now, this is one formula that some of us have tried to crack, and that is a huge opportunity, because if 50% of India's GDP is in the services sector, there is also a need for us to pump in a lot more credit to give a boost to that. So I would say that the SME sector, the services sector, and as a sort of a corollary or a result of this, the housing, the affordable housing, is the third sector which actually has got huge potential. And traditionally, if you see, housing has been a catalyst of economic growth in many, many countries in the world. So these are some of the areas that we as an NBFC can play a significant role and act as a sort of a complementary to the banking system.
Let me go across to my final panelist. Mr. Ghosh, everyone's watching you at this point in time to see how this experiment of yours called Bandhan will become probably a model for the rest of the banking industry, because it's expected that the kind of model that you're looking at, that is combining the last mile connectivity and also ensuring commercial viability, will that set a stage for other banks also to rework on their current model?
Thank you. Very secret news I cannot give before opening my bank. But coming to the serve to the people who are financially excluded, reaching to them is a cost high. And the cause is lot of things is there. I can be mentioned on that. The one cause is their ticket size is small. This is one. They are always demanding it. They like to get the service in the doorsteps. That means that if they will come to the bank branch, they will be at the cost. So they will not like to give them. So if we'll go to their doorsteps, so cost is our. So that cost is high. And these are the two major factors on that. So we are designing in such a way how we can be minimizing the cost with the present banking structure and the microfinance structure combined together, and to reach and giving the doorstep services with a cost-effective model and little bit higher cost, not in a bank cost whatever they are getting from the formal banking services. I give you one of the example on that. If any customer will go to the ATM, there is a cost of bank is a 13 rupees. No, if they will go to the other than their bank, any ATM, and they will be cost is a 18 rupees. Then the 20 rupees is a cost per transaction. So 200 rupees my customer would like to deposit me, and 20 rupees is my cost. Or they can like to withdraw the 200 rupees and my cost is 20 rupees. And again I will give the interest of the 4.5 or 4. So this my cost is high. So we are designing in such a way on that these people will get the services from not from ATM. They will get the services from POS machine. So which is now utilized by the BC model on that. So in that way we are like to minimize the cost. Other factor is there the cost, the employee cost is very high in the banking sector on that. So if you come to the Bandhan as a bank, also their cost also little bit higher on that. But how we can be recruit the people? If I recruit the people MBA to take the deposit 200 rupees and return the deposit 100 rupees, it is not cost effective. If I recruit the people at the Madhyamik or higher secondary, and there maybe the cost is lower than the MBA. So in that way we are like to balancing on that, how minimizing the cost on that. But of course our policy is there to reach to the rural and unbanked areas and also excluded people, financial inclusion. But in a not with a no, is also keep in mind every time on that we are at a sustainable bank. No, financially viable model should be maintained on that.